In this video, we are going to talk about the top 10 investment strategies for beginners. So before starting, please like this video and subscribe to this channel for future updates. A sound investing plan reduces risks while increasing possible profits. But with any plan, it's important to keep in mind that if you invest in market-based instruments like stocks and bonds, you could experience short-term financial losses. It often takes time for a decent investing strategy to pay off, so it shouldn't be viewed as a get-rich-quick program. Hence, it's crucial to start investing with a realistic understanding of what you can and cannot do. Number 10. Dollar cost averaging. The method of adding money to your investments on a regular basis is called dollar cost averaging. You might decide, for instance, that you can invest $500 each month. Hence, regardless of the state of the market, you invest $500 each month. Instead, you might add $125 each week. You spread out your buy points by buying an investment on a regular basis. You reduce the danger of timing the market, which is the risk of investing all of your money at once, by distributing your buy points. By using dollar cost averaging, you may make sure you aren't overpaying for something by obtaining an average purchase price over time. Dollar cost averaging is beneficial for establishing a consistent investing habit. You'll probably end up with a bigger portfolio in the long run, if only because you were methodical in your approach. Number 9. Income investing. Owning investments that provide cash distributions, frequently dividend stocks and bonds, is known as income investing. You receive some of your return in the form of hard currency, which you can spend any way you like, or you can reinvest the funds in other stocks and bonds. In addition to the cash income, if you own income stocks, you may also be able to benefit from capital gains. You might want to have a look at these top dividend ETFs and high dividend stocks. You don't have to pick specific stocks and bonds here. Instead, you can easily apply an income investing plan utilizing index funds or other income-focused funds. You have the security of a consistent cash return from your assets, and income investments often vary less than other types of investments. Additionally, premium dividend stocks frequently see growth in dividends over time, increasing your money without requiring you to do any additional labor. Number 8. Index and a few. Using the index fund technique and then adding a few minor investments to the portfolio is known as the index and a few strategy. If, for instance, you believe that Apple and Amazon are well positioned for the long term, you might invest 3% of your portfolio in each and have 94% of your assets in index funds. This is an effective technique for beginners to stick to a largely lower risk index strategy while increasing their exposure to certain stocks they prefer. The best aspects of the index fund strategy, lower risk, less effort, and strong potential returns, are combined in this plan, which also allows more ambitious investors to add a few positions. The individual positions can be a good way for newbies to get their feet wet with stock analysis and trading while not breaking the bank if these investments don't pan out. Number 7. Buy index funds. Finding a desirable stock index is the key to this method, after which you must purchase an index fund that is based on it. The Nasdaq Composite and Standard & Poor's 500 are two well-known indexes. Even if it's the only investment you hold, it has a number of the most popular stocks on the market, offering you a well-diversified portfolio of investments. You might start by looking at this list of the top index funds. You can just own the market through the fund and get its returns rather than trying to outperform it. Purchasing an index fund is a straightforward strategy that can produce impressive results, especially when combined with a buy and hold mindset. The weighted average of the assets in the index will be your return. You'll also take less risk with a diversified portfolio than you would with a small number of stocks. Also, because investing needs far less work and doesn't require you to research individual stocks, you may spend more time doing other enjoyable activities while your money is working for you. Number 6. Buy and hold. A buy and hold strategy is a tried and true method that consistently works. With this approach, you do precisely what the name implies: you purchase an investment and keep it for the foreseeable future. Whilst it's ideal to never sell the investment, you should aim to keep it for at least 3 to 5 years. By focusing on the long term and approaching investments as owners, the buy and hold strategy helps investors avoid the active trading that reduces their returns. The performance of the underlying business over time will determine your success. And in the end, this is how you can identify the biggest winners on the stock market and potentially make hundreds of times your initial investment. The beauty of this strategy is that, if you decide never to sell anything again, you never have to give it another thought. You can avoid capital gains taxes, which are a return killer, by never selling. In contrast to traders, a long-term buy-and-hold strategy frees you from the daily shackles of market monitoring so you can spend time doing the things you enjoy. Number 5. Growth investing. Investing in growth includes purchasing shares of developing companies that seem set for future growth over average. Businesses like these frequently provide a distinctive commodity or service that is difficult for rivals to match. While growth stocks are by no means a sure bet, their appeal is that if the underlying firm succeeds, their value may rise considerably more quickly than that of established stocks. Growth investors are prepared to pay more for these businesses in exchange for their strong potential for future growth. This category generally includes new technologies. For instance, if a person thinks that home purchasers would increasingly turn to online mortgage lenders with a simplified application process rather than banks, they can invest in the lender they think will dominate that market. In order to find growth, investors can also look towards developing economies or businesses. Emerging markets and developing economies typically experience greater volatility as they industrialize, but they also see faster growth than their more advanced counterparts. Market capitalization, often known as market cap, is a measure of a company's value and is obtained by multiplying the number of outstanding shares by the current share price. Number 4. Start with a new or existing retirement account. A retirement account is one method to start investing. Using a brokerage account, you can open or access an individual retirement account, or IRA. Then decide on assets that are consistent with your objectives. If you already have a 401k through your workplace, it's often a smart idea to start building your IRA after you contribute to your 401k and meet the requirements for the corporate match. Employer match programs offer free money that you shouldn't pass up. You should be aware that because most 401k's offer only a small number of investment possibilities, your options for strategy are typically constrained. In contrast, IRAs provide you access to a wider range of options than your 401k might provide. Number 3. Contrarian investing. Investors can purchase stocks in companies using this type of technique while the market is down. This tactic emphasizes buying at a discount and selling at a premium. The stock market typically experiences downturns at times of recession, war, natural disaster, etc. Investors shouldn't, however, simply purchase any company's stock during a slump. They ought to keep an eye out for businesses with the potential to grow in value and a brand that bars competitors from doing business with them. Number 2. Dividend growth investing. The investor uses this type of investment approach to search for businesses that consistently pay a dividend each year. Businesses with a history of routinely paying dividends are more stable and less volatile than other businesses, and they strive to improve their dividend payout each year. Such dividends are reinvested by the investors, who gain over time by compounding. Number 1. Passive and active strategies. In order to reduce transaction costs, the passive method entails purchasing and keeping stocks rather than trading in them regularly. Passive techniques tend to be less risky because they are believed to be incapable of outperforming the market due to its volatility. Active tactics, on the other hand, require regular buying and selling. They think they can do better than the market and generate greater returns than the typical investor. What do you think about our video? Let us know in the comment box below. Please like this video and subscribe to this channel for our future updates. Thank you.